The housing market is continuing to fall at a record-breaking pace, even faster than what we saw at the start of the global financial crisis, according to the Case-Shiller Home Price Index, with the most recent month of data included. From the peak of June 2022, this housing market index has now fallen by over 5%, which is a staggering decline in just a 7-month period. This is a much sharper drop-off compared to the 1.2% decline in the same time period of 7 months that we saw at the beginning of the global financial crisis in 2006 and 2007. However, something truly disturbing has started to emerge over the past couple of months, something that this Case-Shiller index has not yet picked up on. You see, the Case-Shiller index, while being widely regarded as one of the most accurate and reliable metrics on the performance of the US housing market, is a lagging indicator as the data is delayed by a number of months. We're now in April, and the latest month of data that has just been added for this index is the month of January. And to add to this, the data taken for each month of the index uses a 3-month moving average algorithm, meaning that this January entry is still factoring in housing market data dating back to November of 2022. And in an incredible turn of events, looking at the more real-time data sources, we are actually starting to see the housing market rebound in recent months. Fintech real estate brokers like Redfin and Zillow provide us with much more real-time data compared to the Case-Shiller index, meaning that we can get a head start on where the housing market is moving next. They're able to do this using the vast amount of listings data that they have on their site, and at this point both Redfin and Zillow are big enough to get a large enough sample size of the direction of the housing market in close to real time. And using this Redfin data, the median home sale price has spiked up to $364.4 thousand as of the start of April, which is up by about 5.1% from the $346.7 thousand that we saw midway through February. Inventory levels are shrinking too, which is a sign that demand is outweighing supply at the moment, with the number of active listings continuing to decline to now being just below 700k. This is approaching the lows that we saw at the start of 2022 and far lower than the 950k active listings during late summer of 2022. This shrinking inventory translates to fewer months worth of supply on the market, falling sharply to 2.8 months of supply from the 4.5 months that we saw not long ago in February. With supply shrinking and demand clearly rising, sellers are able to get away with putting their home up for sale at a higher price, with the median asking price rising rapidly by around $50,000 since the beginning of 2023, now almost back up to the highs that we saw in summer of 2022. And these incredible housing market gains are not just limited to a handful of regions, in fact they are present across many of the largest US regions that have the largest housing markets. This chart showing the median home sale price for specific US regions illustrates brilliantly the sort of pattern that we are witnessing across big regions like Chicago, LA, Washington, San Diego and Boston, just to name a few. Boston stands out as seeing one of the largest rises, jumping from a median sale price of $597,000 in February to $650,000 in March, a whopping 8.9% increase in just 1 month, and approaching the highs it saw in late summer and early autumn in 2022. San Diego has also seen a rather insane spike in median sale price, going from $765,000 at the end of 2022 in December to now being $825,000 as of March, a 7.8% rise in price, and now very close to the high that we saw of $877k in April of 2022. Miami also stands out on this chart too, because it is the only region here that has actually now reached a new all-time high. As of March, the median home sale price in Miami was $500,000, surpassing the previous high of $490,000 in May 2022, and this is also a massive 9.9% higher than just a few months ago in December. Data from Zillow is painting a similar picture too, and looking at Zillow's Home Value Index for the month of March, we can see that literally every region bar one on this index has experienced a gain in home value month over month. The only region that has experienced a month-over-month decline was New Orleans in LA, but every single other tracked US region on this index has enjoyed a healthy gain last month, many well above the 1% mark, which is a very high monthly gain. So home prices are rebounding in quite a strong way. So what makes all of this so alarming? Well, the reality of the situation is that this rebound is only likely to be short-lived, and it is just delaying the inevitable. House prices spiking up now means that a crash will be even more severe and chaotic in the future. All of the economic metrics that we use right now to judge whether the housing market is over or undervalued are all still screaming overvalued. Housing affordability is one of the best metrics to judge the current health of the housing market and whether things are likely to keep surging or correct in a major way. The three main components of housing affordability are home prices, mortgage rates, and household income. And home prices across the US are vastly higher today than they were a few years ago at the start of 2020, and in fact it has been the best performing 3-year time period for home price appreciation in recent history. According to the same Redfin data, at a national level, the median home price sale has risen from $290,000 in January of 2020 to now being $401,000 as of March 2023, a 38.3% rise in just over 3 years. This is vastly overperforming the average annual home price appreciation that we have seen across history, and although we are down slightly from the absolute peak that we saw in summer of 2022, it's safe to say that home prices are still very high right now. Mortgage rates have skyrocketed as well over the last year or so and are now at eye-watering levels that mean it's very difficult for many people to afford a mortgage, and even those who can afford one are sacrificing a large portion of their income. The average 30-year fixed-rate mortgage in the US is 6.27% right now, more than double the rate that you had to pay little over a year ago at the end of 2021, where this rate was around 3%. Current mortgage rates are the highest that we have seen in recent history, and you'd have to go back as far as 2008 during the global financial crisis to find a time where they were last this high. To put into perspective what this does to affordability, a $500,000 mortgage at a 3% interest rate would have costed you just over $2,500 in monthly payments, but today on the current 6.27% interest rate, that same $500,000 mortgage would set you back just over $3,500 a month. Now that is a $1,000 increase in housing costs every month, which is a 38.5% rise for the exact same value mortgage, all of which is due to the high interest rate payments. And then the third pillar of housing affordability is the average household income, which has seen lackluster growth in recent years. The mean personal income in the US has risen from $54,000 in 2020 to now being $57,100, growing by a measly 5.7% in 3 years. Now when you compare this to the 68.5% rise in mortgage rates and the 38.3% rise in average home price value across the same time period, this is a big problem for affordability. Putting all of this together, when we look at the payment to income ratio right now, we can see just how unaffordable housing is relative to historic levels. This metric measures the share of median income that is needed to make the monthly mortgage payment on an average price home at the average mortgage rate. And it is costing US households 33.2% on average of their income every month for housing costs, much higher than levels that we've seen for the past decade or so, which have been more around the 20% region. Again, you'd have to go back to the peak levels seen during the global financial crisis to see the payment to income ratio being this high, a very telling sign on where things are right now in the market. And what's even worse is that the data used for this chart is only up to date for the month of February, and so it's not factoring in the gains that we have seen for the whole of March and half of April. And this of course means that next month's report is almost certainly going to show a rise in the payment to income ratio, meaning that housing affordability is actually even worse than what this chart is showing right now. What's even worse as well is when you actually look at some specific regions, some of which I mentioned before of the regions that have actually spiked up in price recently, the house payment to income ratio for these regions is even higher than this national average, and some of them are well up into the 40% area and some are even above 50%, which is incredibly high. So there could definitely be some turbulence ahead for the housing market, but the whole economy could be in trouble too, as Jamie Dimon, the CEO of JP Morgan, has recently issued a terrifying warning on where the economy could be heading in the future. I take a closer look at this warning in more detail in my recent video, which you can check out by clicking on the screen right now. Aside from that, please leave a like on the video if you enjoyed it, subscribe if you want to see more, and thanks a lot for watching.